Welcome to the crowd. My name is Sherwood Neiss. On this week's episode, I want to take issue with a policy proposal that's in front of the Senate Banking Committee. But first, let's get to the index, the last week's top offerings, and who performed the best. The Online Investment Index, which tracks the daily top 50 regulation crowdfunding offerings, was up 14.85% or 69.1 points last week. Looks like April is going to be the second highest month in terms of commitments for the history of regulation crowdfunding. It's going to be hard to top March, which had $70 million, and a lot of that was due to the excitement surrounding the new $5 million regulation crowdfunding cap that went into effect on March 15th. But April looks like it's going to be over $40 million. February had $43 million in commitment. There's still a few days left in April, so it'll be interesting to see if we break February's totals. We have about 684 open offerings right now. I'm noticing a lot of issuers are extending their campaigns out a year and doing rolling closes. This means that they are running longer funding windows, and I do have two thoughts on this. Based on all our industry data, it would seem that most of the campaigns perform well because of that limited window within which to invest. The limited window is typically around 90 days. This creates a need for investors to make a decision without waiting too long. So a longer window, I think, removes some of the excitement around an offering, and I don't really expect, just because these funding windows are longer, that investors are going to be pouring more money in over the longer window period. It just doesn't necessarily equate to that. Second, if you don't get in on a popular round and it closes, the next time you want to get in, the price to investors will probably be higher. So that bodes well for those investors that get in early in some of these deals, but not as beneficial for those investors that miss out on a cheaper valuation from a prior round. So what this means really is the longer funding window is open, the longer that fixed valuation is there. Now, again, for those investors that get in on the beginning, it might not be so beneficial. But if a company is growing and they want to actually have a higher valuation, it might benefit them to do multiple closings and do multiple offerings so that they can do a new offering with a new valuation. And again, this only applies to those companies that are really in the hypergrowth and excelling phase. So now let's look at the top 5 companies from the index last week. First, we have StackSource, which is a Newark, New Jersey-based online real estate funding platform. Once again, this offering defies the negative bias argument promoted by some old school VCs that issuers only turn to the crowd when they can't get capital from VCs. StackSource is backed by Techstars, Newark Venture Partners, and real estate industry executives. Last week, they raised $578,000 from 99 investors. That's an impressive $5,800 an average investment for each of those investors. In total, they've raised $2.5 million from over 700 investors at a $13.8 million valuation. Next up, we've got Cytonics, it's a Florida-based biotech company that is developing diagnostics and therapeutics for osteoarthritis. They are running a Series C offering on Seed Invest, so they've done multiple rounds already. They've raised $552,000 last week from 274 investors, a little over $2,000 average investment. In total, they've raised almost $3.5 million from more than 2,000 investors. Next up, we have Fanbase. Now, they've been on the top 5 list 2 weeks in a row, so this deal continues to have momentum. They're an Atlanta-based new Facebook alternative subscription service that's helping users monetize their content and earn revenue. How great is that you now can make posts, but earn money while you're making your posts. Users can grow their following organically with the ability to follow each other for free on a platform with the option for a paid subscription service to exclusive content. This does help users monetize their followings, unlike platforms like Facebook. They raised $475,000 last week versus $780,000 the week prior for a total of $2.7 million. It's about $1,700 average investment in their offering. Next, we have wigl. instead of Wi-Fi, Wi-full. They're a Hampton-based Virginia startup where you can get wireless power the same way that you get Wi-Fi. Wow, so no longer are you going to need cords to plug into your phone. That's pretty cool. They raised $401,000 last week from 411 investors. Total raised to date is over $2.7 million from almost 2,700 investors, which is about $1,200 average investment. Finally, we have Blue Shift Aerospace. They're a Brunswick, Maine technology infrastructure company that, get this, is building the world's first biofuel-powered rocket ships that bring small satellites into space. They had their first successful launch in January of this year, and last week they also launched their online investment offering and raised $381,000. These 5 companies have a collective value of $154.6 million. Keep in mind the total collective value of all the companies that have been successful in a regulation crowdfunding offering is over $19 billion to date. So that speaks volumes to the opportunity in this space. And there we have it. We've got finance, biotech, social media, power transmission, and aerospace. Just, another wonderful week with broad industry application and regulation crowdfunding. So obviously some of these will garner follow-on rounds from more institutional investors, but it's going to be great and very interesting to see how some of these early retail investors perform in some of these deals. Okay, now on to what's happening in Washington, D.C. Right now, in front of the Senate Banking Committee, there's a call for proposal to boost economic growth. I'm thrilled, actually, to see that regulation crowdfunding is part of this, part of the topics that they're discussing. But I'm not happy to see that some of the comments that are being made are that this exemption has been of relatively minor importance, largely due to the regulatory and statutory structure of the exemption. I just take issue with this. Raising money from investors requires building confidence in why investors should be part of a deal and should part with their hard-earned money. This requires that companies provide information that helps investors make these decisions. Companies just don't know what type of information they should be disclosing. That's why we spelled it out in the legislation and came up with a structure for it. This information, or what we call disclosures, includes information on the business, their operations, how much money they need, and how they will use it. There's nothing out of the ordinary here, and it shouldn't be seen as a deterrent to capital formation, but rather a necessity. I would also argue, as many of the investors in these regulation crowdfunding deals are retail investors, they need to be presented with more information that is easy for them to digest than their accredited counterparts. I'm all for making adjustments to the industry that would benefit it, but to say that the structure of this exemption is holding back the market is just plain false, and the data does not show that. So that's all for now. Make sure to subscribe to our channel to get the latest news and follow me on Twitter at WoodieN, WOODIEN. This is Sherwood Neiss with The Crowd, and we look forward to seeing you next week. Thanks. Bye.